One index that is outperforming everybody else by leaps and bounds, and you probably won't guess if you've not looked at the screen recently. It is, in fact, the PSU Banking Pack, which is up as much as 27% in the year-to-date 2024 alone. And the Nifty Bank in that same period is flat, almost completely unchanged. So the big question that we're asking is what's going on? Has there already been a valuation re-rating, and what's the potential going forward? Harsh has some of those answers. Harsh, the first question I think everyone's asking, what's going on?
Well, a couple of factors playing out within the entire banking space, Alex. One is there is clearly a deposit growth war. The reason for that is typically deposits allow room for lending growth. Where the PSU pack is concerned, or the PSU banking pack is concerned, in any case, your loan to deposit ratios at the start of this deposit war or cycle was anyway very, very reasonable. It was roughly 60-65%.
And that's healthy.
And that's not healthy per se, but it puts you at an advantage when a deposit growth war comes. And therefore, when the deposit growth now, when everyone's chasing deposits, PSU banks don't have to essentially do that. And that's one of the possible primary causes of this re-rating that has happened outside of asset quality and fundamental factors, which in any case are improving across the board.
You're talking about the credit deposit ratio being one of the primary aspects to focus in on. This is coming at a time when it is at the highest level for the industry than it ever has been. And that's primarily because of HDFC Bank, is that right?
It's not primarily because of HDFC Bank. It's just given the system liquidity compression that has happened, which is causing this this kind of mismatch between loans and deposits. In any case, the RBI has highlighted at various points that they want, or they're guiding banks to increase and to expand loan to deposit, so that you have a larger deposit base to essentially ensure lending. So
okay. And PSU banks have been more successful in garnering these deposits, is that it?
Yes, PSU banks have not been successful in garnering. They've started off on a better footing. Loan growth is not something that they have done for a very long time, and hence deposits kept coming in.
Right.
And therefore, your loan to deposit ratio was essentially very favorable at the start of this cycle, which has essentially continued to improve through the course of the cycle. And what's therefore happened is you're sitting with loan to deposit ratios of roughly 75 to 80% within the PSU banking basket. And within the larger private banking basket, when I'm looking at it, you're roughly in your late 80s to 100% plus.
Right.
And that causes concern, because you essentially can't grow loans if you aren't able to garner those many deposits. But the private banking side has repaired that in Q4. Very, very strong set, 5% plus sequential across banks, except probably a South Indian bank, which hasn't done too well. Outside of that, I believe most banks have done very, very well to improve that credit.
Would it also
ratio.
be a factor of the type of deposits that they're getting and the cost of deposits for PSU banks vis-a-vis the private sector banks? Because some of these private sector banks that have amped up their deposit growth in the quarter gone by have gone the wholesale route. So is that something the street is also focused on?
So, Alex, yes, for sure they are focused on. But when you're looking at the PSU bank versus private bank kind of play, the PSU banks currently are in a situation where they can stand back and say, we're fine in terms of deposit growth or letting go of deposit growth. We can only focus on loan growth because the LDRs are so compressed. And on the other hand, you have, on the other side of the spectrum, you have private banks, where they believe that any kind of deposit that they get is a positive because it helps them lend.
And they possibly have to slow down loan growth.
Correct.
So therefore, there's a potential for public sector banks to garner that share of the pie.
Correct.
Okay, so that's the way to look at it.
Yes.
Potential for.
Yes, but nonetheless, the public sector banks haven't grown their loan base in a very material manner or significantly higher. Private sector banks' growth continues to outstrip public sector banks, if that's how I can put it. even now in terms of the numbers that have come in for Q4.
So then, what are we talking about? Are we talking about the potential resulting in a requirement for a valuation reset or a valuation re-rating? What do the multiples look like right now?
So valuation re-rating definitely playing out, and that's not just because of the observations with regard to loan to deposit. It's also with regard to a couple of more factors. One, they have very small, or they have a very small mix of unsecured, where there is a possible asset quality problem which the RBI has flagged. Second, they're looking at all-time low NPA ratios, and therefore the valuation mismatch between, or rather the valuation difference between private and public sector banks has compressed materially. And third is that you have limited margin contraction.
Why is that?
Given the fact that you aren't chasing deposits in a big way,
Sure.
and therefore you haven't needed to hike deposit rates in a big fashion.
What we talked about wholesale deposits as well.
Correct.
Yeah.
So they haven't needed to hike that, and therefore the margin contraction has been limited. It has been there in Q3. We've seen that in Q3. So please don't get this wrong. But it's been limited in comparison to the private sector peers.
Okay.
And therefore, you are seeing a lot of this play out on valuations. Compared to their 5-year averages, valuations are expensive within the PSU banking basket. But over the last 5 years, mind you, we've seen a deep cycle when it comes to the PSU banks. They've gone through a bad cycle. They've come back from it. And therefore, a little bit of valuation re-rating is necessary, because that's just
I
how
see you point out
efficiency
SBI at 1.7 times price to book value, PNB and BOB at 1.4 and 1.2 respectively. That's not very high, is it? I mean, but traditionally SBI has gone to as low as 1 times, right?
Even below 1 times,
Right.
Alex.
Yeah.
If SBI was at one point trading at 150 rupees, COVID low,
Sure.
maybe 170 to 200 for a very long stretch of time, which is 0.5, 0.6 times price to
Sure.
book for it at that point of time. And therefore, it was trading at an extremely reasonable
So now
valuation.
it's a little expensive.
Now it's gone up, of course. You've seen it go 3x plus the book value consolidate even further, and therefore it's trading at roughly 1.7 times. But you look at some of the others, BOB, PNB, CanBank, in comparison to the private sector peers, they are still 25 to 30% cheaper. And this is just the big four. I'm not talking about some of the smaller banks where valuations have significantly started to stretch.
Sure.
We've seen valuations currently within the smaller PSU banking basket almost 2.5 to 3 times.
Right.
IOB is trading at roughly 4.5 times price to book.
Okay.
So somewhere that pocket needs some bit of caution given just in terms of relative valuations versus private banks and versus their own 5-year averages.
Okay, so I think we've covered the basis as to why you've seen a bit of a jump in these prices. The question is whether that sustains, and as Harsh just pointed out, in some of the smaller banks, perhaps the valuations are looking a little bit stretched.